Well, I think as far as gold's concerned, demand there is competing with Asian demand, and it's setting a physical price. So I can't see. I honestly believe $8,000 gold. People say, "Oh, how can you get?" Well, okay. Well, we figured 4,500 gold by the end of this year, and that was only at it was 2,900 or whatever it was.
Yeah.
I mean, you start breaking some of these barriers, and the race starts to really accelerate. Now, as far as silver's concerned, I think you've got so much demand in there into a supply shortage, which is not factored into the price. And we've still got a gold price ratio that is so far away from God's ratio. It's even if it was to come back down to the 30s, or there's your prices, there's your 80 or $140.
Physical demand is now overwhelming the old paper-based structure, pushing gold and silver into a pricing regime defined by real inventory rather than leveraged futures. With physical bars tightening across global hubs and every dip being absorbed instantly, the market has entered a phase where flows, deficits, and institutional allocation are setting the trajectory. The Western Treasury system is showing visible stress, forcing asset managers, funds, and sovereign buyers to shift toward metals as core reserves rather than peripheral trades. Andrew Maguire, a long-standing analyst of physical market mechanics, notes that gold's advance is accelerating into a zone where $4,500 becomes a stepping stone toward $8,000 as physical premiums rise and institutional allocations grow more aggressive. Silver's setup is even tighter, with supply deficits, AI-driven consumption, and photovoltaic demand creating conditions for a rapid revaluation. Once the gold-silver ratio begins normalizing, silver's path expands toward $80, $140, and potentially $200 as real metal replaces synthetic pricing. These levels reflect not speculation, but the unavoidable repricing of a market that has been held below equilibrium for decades. Now, we present the clips from Andrew Maguire's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Well, I think as far as gold's concerned, you've got two, for all the reasons that you've just said. What if there was a black swan event? What if there are cockroaches running around? So if institutional buyers are in there, and I mean, forget everyone else in Asia who views it differently to people in the West have, but need that exposure, then obviously, as far as gold's concerned, then they've still got to allocate more and more and more. Price is inelastic. It doesn't matter. They're just going to dump more dollars and get that exposure, because we'll go out of risk into cash and into gold. So that demand there is competing with Asian demand, and it's setting a physical price. So I can't see. I honestly believe $8,000 gold. People say, "Oh, how can you get?" Well, okay. Well, we figured 4,500 gold by the end of this year, and that was only at it was 2,900 or whatever it was.
Yeah.
I mean, you start breaking some of these barriers, and the race starts to really accelerate. Now, as far as silver's concerned, how? I mean, we've already talking about a supply deficit. Now you're talking about the AI boom. So even if there's a slowdown, you have to look at the market. As overvalued as it may be, AI is going to require a lot of silver. Photovoltaic, we just talked about, photovoltaic supply. Again, we're talking about 20 tons for each gigabyte. Everyone is producing. Everyone wants green energy. Not even talking about AI at this point. So I think you've got so much demand in there into a supply shortage, which is not factored into the price. And we've still got a gold price ratio that is so far away from God's ratio that it's, even if it was to come back down to the 30s, or, I mean, there's your prices, there's your 80 or $140. I mean, you just, because how can that ratio isn't a God ratio, it's a synthetic
ratio. A leverage ratio. Yeah.
It can only be synthetic. It has nothing to do with reality.
Yeah.
So when this whole thing levels out, because physical markets will determine that price will wash back into where the crooks are, who have derivative bets that are based on bets made years ago and have been doubling down and figuring, well, it'll get better. It ain't got better. It's broken. I think, I think I can't see why. It's not just being optimistic here. It's just a question of how high will it go before real bullion comes to on offer to actually meet the actual demand. If I'm take a position, it's visible. There's only a couple of big guys controlling the book. Of course, they're going to take you out. Of course, they will, and they do it on a regular basis. So, momentum traders, to answer your question, here's what happens. So they decide, it finally breaks out. What do? Oh, we're going up this time. So they hang on to the coattails of what is actually a physically driven market. But they get so much bloated open interest. So what you need to do is, of course, in the meantime, the COTs, the same guys that we know that operate the LPMCL pretty much, same footprint in both markets. And what do? Go short against every single one of those guys, knowing, guess what? Let's go to just about there, margin call. Oh, let's do another one. Bang, out they go. What they've done is they've literally popped the bubble. Thank goodness, good riddance to the whole lot of them, because essentially all that did was put them into the other mode of shorting the market with the same commercials taking the long side of them. So by the time we get this equilibrium that we were just talking about, these guys are pretty much out, long or short. They've just been rinsed of their shorts. So I think what we've done is just establish the next in the series of higher physically supported step. That's been the process. And my goodness, be great. I mean, we're $2,000 up from, we're like $23 higher than the beginning of the year, over $1,500 higher in gold for the beginning of the year. I mean, you only have to step back and look, take the chart chatter out of it. What a good marketplace this is. And it's not being driven by these the Western cartel, basically. And I think they've really, to me, they've blown it. They've lost all the good clients. They've lost all the institutions. They're now reduced to gaming a very few, declining open interest of that. Really, any open interest that's in there is just really mostly speculative. And I think the parameters of that are so contract. Whereas before you could create a $500 waterfall. Sorry, but in this is a lot of physical buyers where you have to, who operate in physical exchanges, as you know, where you have to buy that bar if you want to sell, as opposed to just putting 4% of skin in the game, 96% leverage position, which is just chasing a price, a dot on the screen. And all we saw was this dot on the screen get squared up, and off we go to a much higher stair step. Yeah, I think silver was just a little, was just the more obvious version of that. But yes, because it's hard to hide the footprints. But absolutely, this is, as we know, central banks, sovereign, institutional buying. Now, all of a sudden, we've got, for all the reasons you have, the cockroaches running around in your treasury markets now. And I think people are looking at it and going, hey, I really have never had exposure to gold. So institutional traders, buyers are saying, I need some exposure. So the problem is, and this is what's confusing a lot of people, problem is a lot of these guys are not mandated to hold physical, especially the US guys, not mandated to hold physical. They can buy and sell shares, and they can do it on the click of a mouse. They are now, as we know, we're talking about the 2020. So we're looking at a lot of people coming out and saying 20% allocation to gold. Hey, can you remember any of this trade?
Goodness.
I mean, it was like you wouldn't even have 1%.
Right.
You wouldn't have a 0.5%.
You're a lunatic to even bring it up.
Exactly. So now you've got all these institutionals. Now, the interesting thing is they can't necessarily buy physical. They're buying the ETF. Now, you and I are great. We don't believe in the last place I want to go and buy gold is an ETF. However, they have no choice. So, but because they're buying for keeps, they're not going to take delivery. They are going to own that position, and it's sticky. They cannot be rinsed. You cannot say, in fact, you drop a price down, they'll buy more because they're buying more every day because they're moving from zero allocation to 20 to 25% and more in some instances for obvious reasons. So therefore, people look at it and go, oh, look, there's all this open interest building in the ETFs. It's not speculative. This is sticky stuff. And obviously the physical market is all we care about, but it actually is forcing, even though there's shorting going on in the GLD and one thing and another, it's still a physical market. And it's the physical supply demand is being set outside of the LBMA ring fence. And so therefore, it's back to same as silver. If I have a bar and I have to own it before I can sell it, I need a real price. I want a real price. So I will only sell it to you. And the more you want, more I want.
Silver's tightening supply profile is now colliding with a derivative structure that no longer reflects real-world availability. Persistent backwardation into major delivery months, collapsing liquidity among Western market makers, and the shift of price discovery toward physical exchanges in Asia signal a structural break in how the metal is valued. With producers, refiners, and industrial buyers forced to secure inventory in advance, each bar offered to the market now reflects proper supply and demand fundamentals rather than leveraged pricing signals. The underlying deficit is expanding as photovoltaic demand, AI-related consumption, and large-scale industrial requirements draw more metal than global production can replace. Market participants seeking actual delivery are accelerating outflows, leaving fewer warrants and weakening the ability of legacy exchanges to suppress volatility. As synthetic pricing loses influence, silver is positioned to migrate rapidly toward levels consistent with physical scarcity, where backwardation becomes persistent rather than episodic. Let's get back to the interview.
You can't print silver. You can print more money to buy more gold at a higher price, but there just isn't the silver there. It's just not there.
Yeah.
So how the hell are they going to extricate themselves from this position? That's why they're in backwardation into a delivery month. Where does that extrapolate out?
Yeah.
To me, it's $80. That's where it extrapolates. Again, pretty much what we've just discussed about gold. It's the same in silver. The real actors are gone. And I think this open interest that's in there, it's very limited as to what they can actually rinse out, because we've got physical markets being set in China. We work with the liquidity providers who interact with the Shanghai International Exchange, and really looking at what they're talking about. There's very little. It's interesting because I think what really sums it up, and you and I were talking about backwardations a little while ago. While we have unprecedented backwardations, we've seen $3 backwardations in the past. They get arbitraged one thing and another, but so close to first notice of the largest delivery contract of the year. We're seeing on last Friday, 60 cents, $3,000 per contract offside. Now we're still looking at 20, 30 cents. I mean, ludicrous into first notice. Through options expiry into first notice, which is actually supposed to be tomorrow, but it's actually happening today. Silver is the Achilles heel of this same group of people. RPMCL are just the four banks that basically control the cartel, basically. And I think their liquidity is completely blown to smithereens. All the institutional guys, as we've just said, they've exited. And now you can still access as an institutional trader. I can then go in and tag the SGEI gold corridor, which is opening up big time. Can access an increasing number of vaults, gold and silver, that can be traded with a real physical price that is much more stable than this unbelievable paper toxic mix that is thrown in. And it only serves. And I think the reason that we're seeing less volatility and the reason we won't see these kind of big sell-offs again, there's just simply not the liquidity to do so. It's gone. It's literally gone into physical markets. And if I'm a producer or a refiner or something, why would I want a price that's so volatile? I just want to know supply demand. People are owning a bar before it's put for sale. You have to own it before you can sell it, which tells me that if you put it up for sale, that's a proper price. I don't care what that price is. It's the proper price. Right. It's not a COMEX derived price. It's a physical price based on supply demand on the day, based on purely on that supply demand. That is how markets are supposed to trade. And we've been gaslighted, or many people have been gaslighted into believing that this huge COMEX volatility is the market. It just amazes me. You remember years ago, we used to talk about we have a big client. We go to UBS and we say, can we have X amount? They say, no, that's all you can have. Hang on, no, we'll pay you for it. It's just like, just give us a price. No, you can't have it. And it's like, okay. So then it tells us what the game is. The game is make sure, if I'm a seller, I'm UBS or JP Morgan, I've got silver at this price. I don't want to sell anybody. But I've got to look like I'm making a market. So make sure that Samsung, Nokia, and all these people get their silver, because if they don't get it in time, they're going to come to the market and just buy everything that they can. And the price is going to spike higher. Their derivative positions that relate to these. The reason they're not selling is because there's derivative positions attached to these physical bars, multi-leveraged. You know all about this. You've been talking about it for years with your clients. And it's like, well, of course, it's mispriced. So I think they can't actually, they've lost the plot. There is literally nothing they can do. They might want to do it, but there comes a point now where, it was just really interesting. I met a guy just a short while ago who's just written a book, I think 1,000 Reasons to Buy Silver. And he's saying, do you know that it takes 20 tons of silver to make 1 gigabyte in photovoltaics? I say 20 tons of silver to make 1 gigabyte. And he said thousands of gigabytes are required. He said, so there's a supply shortage.
Wow.
And now we've got another 500,000 ounces a year of stuff that doesn't include AI. I mean, where's this silver going to come from?
Right.
These guys have dug a hole for themselves. It's a multi-billion-dollar hole. There isn't the silver there to fix that hole. So the market's just simply going to run off with the SGEs are going to set the price. So if you have a mispriced position and it just happens to be a little bit backwardated at the moment, what happens when it is $3, $5, $10 difference and permanent? What happens to the COMEX then? Because the January contract is already at par. You've got backwardations in December, although the next liquid contract is March. But when you look at silver, sorry. So, but then if you look at January, that's already in technical backwardation. I think this morning I looked, there was still 2,000 odd tons of silver warrants floating around in there, and the thing is, there's a lot of people that I know and who are saying, well, yeah, we bought and we're taking delivery. We are taking delivery.
Mm-hmm.
Why? Because it's the only source of physical that I can get to my limit, to my actual limit. I can buy that. And so if that's the only source of physical, going to be banging on that back door, out it goes. So how can that possibly be, and that's mispriced. It's so grossly mispriced. And furthermore, even if it was more expensive, people would still be lining up to get it because there's not enough on offer to meet all the demand. So it is a toxic mix. And as I say, that's why I think these guys are like rats fighting in a cell.
The tightening grip of physical demand is reshaping both gold and silver in a way the paper markets can no longer mask. Gold's inelastic bid, driven by Asian accumulation, institutional repositioning, and the erosion of trust in sovereign debt, has paved the way for multi-thousand-dollar benchmarks that once seemed impossible. Every structural barrier that breaks accelerates the next leg higher. Silver's setup is even more explosive, with persistent deficits, photovoltaic consumption, and AI-driven industrial use overwhelming a system that cannot manufacture supplies. Backwardation, shrinking liquidity, and the migration of price discovery to physical markets signal that synthetic ratios are losing control. Once equilibrium snaps back to reality, silver's repricing could be abrupt, shifting from decades of suppression into levels that reflect absolute scarcity rather than leverage. Share your thoughts on his analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.